Everyone's bullish. Stocks are up. Crypto's pumping. Headlines scream new all-time highs. And Twitter's calling for the next 10x. But here's the question. If everyone's buying, who's left to buy next? And if the market only goes up, why does it keep punishing the overly confident? In this video, I'm going to show you the hidden risks beneath the current rally, the kind most traders ignore until it's too late. You'll learn how to spot warning signs, protect your capital, and prepare for what happens after the euphoria fades. I'm David, a registered international investment analyst with 20 years of real-world trading experience. I don't sell hype. I teach reality. If you want to trade smarter, not louder, hit that subscribe button and join our fan group on the channel homepage. The crowd follows emotion. We follow risk. So what risks should traders be watching in today's US market? Shock from employment data. ADP private sector jobs miss expectations. The June ADP report showed a surprising slowdown in private sector hiring, raising concerns ahead of this week's official non-farm payrolls report. Market reaction. The Nasdaq and S&P 500 pulled back slightly, while the Dow remained relatively stable. Pressure on tech giants. Big tech faces headwinds. Since July 1st, tech stocks like Tesla, Nvidia, and Broadcom have faced selling pressure, partly due to renewed controversies involving Elon Musk and Donald Trump, contributing to approximately 0.8% pullback in the Nasdaq. Surge in FX hedging by foreign investors. Foreign funds ramp up dollar hedges. With the US dollar down over 10% YTD, foreign investors have increased their hedging ratios on US stock holdings from 50% to 75%, using tools like forwards and options to manage currency risk. Policy and trade catalysts. July 9th trade deadline looms. Markets are watching whether the Trump administration will strike a trade deal before the July 9th deadline, a key risk factor for short-term volatility. Trump threatens to replace Fed Chair. Trump hinted at possibly replacing Fed Chair Jerome Powell this fall, which could be seen as a dovish signal by markets, but may also heighten inflation expectations. How should you approach different assets? Right now, US stocks. Caution ahead, possible pullback. US equities are currently under selling pressure. Given recent market behavior, a short-term pullback is possible before any further upward move. From a strategic standpoint, it would be prudent to wait for a correction before entering new long positions. Gold, beneficiary of risk-off sentiment. Gold, as a safe haven asset, stands to benefit if US equities decline and the US dollar index weakens. In the current environment, the overall strategy remains bullish on gold, especially if risk-off flows intensify. Cryptocurrencies, long-term bullish, short-term volatile. In the long run, crypto assets are poised to benefit from legislative support for stablecoins across major economies, the expansion of stablecoin issuance, ongoing blockchain infrastructure development. However, in the short term, cryptocurrencies are still perceived as risk-on assets and could be negatively impacted by any downturn in US equities. If the stock market corrects, crypto assets are likely to follow. Overall market outlook. Uncertainty over tariff policies, weakening US employment data, and Trump's proposed legislation posing headwinds for tech stocks are all contributing to significant near-term selling pressure in the US markets. If you found this helpful, don't stop here. I've got more videos that break down real trades, strategies, and market psychology. Click one of the videos on the screen to keep learning, and don't forget to hit subscribe so you never miss a real-time market breakdown. I'm David, helping you trade smarter, not harder. I'll see you in the next one.